Hi, guys. Welcome to our next lesson. So, during the 1920s, as you know, the economy was booming and it looked like it would never end. Then, the 1920s came to an end, and so did the economy. And one of the reasons was because the stock market collapsed in 1929. And that's what we're going to take a look at today in class. So, today, we're going to take a look at the stock market crash of 1929. Specifically, we're going to try to figure out why the stock market collapsed and what was the result of that collapse. So grab a pencil, paper, open up some notes, get ready to take some notes, and hopefully when this video is over, you'll have an answer for this question. So most historians agree that there are four causes of the collapse of the stock market in 1929. The first one being speculating on stocks. Number two was buying too many stocks on margin. Number three was ultimately the falling price of stocks, stock prices. And the last one, number four, was the loss of confidence in the market itself. So let's take a look at those four causes a little more in depth. The first major cause of the stock market collapse was speculation. Speculation is nothing more than gambling, really. People were gambling on the stock market. They would get some hot tip that a stock was going to do well, so they would try to buy as much of that stock as they could. And it really became almost like a contagious disease, especially to some of the middle and lower income classes. They saw this as a prime, quick way to be able to get rich quickly. Unfortunately, like with any form of gambling, the chances of that hot tip actually paying off are generally pretty small. It's not very common, it's very rare. But it wasn't just people, individuals that were doing this. Companies began speculating on the stock market as well. A lot of companies would take the profits they'd earned and they would, instead of investing in themselves, expanding their own companies, paying their workers a little bit better, instead of developing new products, instead of doing that, they would start to pour their profits that they were making into buying stocks in other companies, because they thought this was a way to make a lot of quick cash. Turns out that's not a great way to run a business. Cause number two was buying stock on margin. When you buy stock on margin, essentially you're purchasing stocks on credit. The idea is that you would put down a small down payment, then you would borrow the rest and plan on paying the rest of it back as your stock makes profit. So buying on the margin was how most middle and lower income people bought stocks during this time. That was the only way they could really afford to do it. So here is a chart that kind of explains how buying on the margin works. So say you wanted to get $10,000 worth of stock. You don't have $10,000, right? You do have $5,000. So you put down your $5,000 as a down payment and you borrow $5,000 from some sort of stockbroker. Well, as long as your stock makes profit, as you see right here in the second column here, say the value of your stock goes from 10,000 to 15,000, you have enough money in that profit to pay back the person you borrowed money from, the original 5,000 you borrowed, right? It's all good. All's good, all's well. You get to stash $5,000 in your pocket, right? You've made a profit here. But what if that stock loses value? Let's say instead of being worth $10,000, say it goes down and it's only worth, as you see in this example here, $7,100. Well, even though you can sell that stock and get $7,100 for it, you still owe your broker $5,000. So you've essentially lost $2,900, right? Because you initially had $5,000. $2,900 of it is gone now. You only have $2,100 of your original money that you had left, and you still owe $5,000 back. You have to give that $5,000 back, right? Now let's say the value of the stock continues to drop. to, for example, let's say it drops to $3,500. That's how much your stock is now worth in total. Remember, you still owe $5,000 to the broker who lent you the money in the first place. Now, in this situation, you're going to have to come up with another $1,500 somehow in order to pay back the $5,000 to the person who loaned it to you, to pay it back to the broker. And it's not going to be from the profits of the stock, because there are no profits. You are in the red, as they say. You owe money now. You've lost. And this is why buying on the margin is so risky. And you really shouldn't do it unless you really, really know what you're doing. Cause number 3 was falling stock prices. And this really comes to a head on a day that's known as Black Thursday. It's October 24th, 1929. And what starts to happen is that stock prices in general, across the board, start to dip a little bit. And that's really just the nature of the stock market, even today. Sometimes stocks go up, sometimes stocks go down. On that particular day, it happened to be a down day. And people start to sell off their stocks, especially people that have bought those stocks on the margin. They obviously, rightly so, some start to get a little scared. I might have to owe somebody a lot of money if I don't get out now. So they start to sell off those stocks. And what they didn't realize is the more stocks they tried to sell off, the lower that would drive the prices of stocks in the market. And we've talked about this in class. We've mentioned it a few times. The law of supply and demand. You're going to learn more about it in depth in economics. So basically how it works is anytime you have a high supply of something, the price of that item, whatever it is, goes way down. And that's what starts to happen on Black Thursday. Prices start to plummet. They start to go down. After Black Thursday, prices continue to fall. And this is where we start to get into cause number 4. People start to lose confidence. They start to lose confidence in the stock market in general. For the next 4 days after Black Thursday, prices of stocks continually fall until we hit October 29th, 1929. And this day is known as Black Tuesday. This is the day that historians say that the stock market officially crashed in the United States. Prices just absolutely plummeted, as you can see in this chart, this graph here on the left. Thousands and thousands of people tried to sell stocks. They tried to recoup whatever kind of money they could get, but it just kept driving the prices down. By the end of the day, the stock market had lost $30 billion. That's $30 billion in 1929 dollars, not today dollars. This was a huge sum of money to be lost in a single day. And this event shattered people's confidence in the stock market altogether. Nobody was willing to buy any of these stocks for sale because they didn't think they would ever see their money again, that they would ever get their money back. So what happens after the stock market officially collapses? The short answer is a few months after the stock market collapses, banks start to have some serious issues. A lot of people who had their money saved up in banks started to get really nervous. And they would go to those banks and they would try to withdraw all the money that they had. They figured it was safer stuffed under their mattresses. People were literally taking the money out of the bank and putting it under their mattress or crammed into their piggy banks at home. They felt that was safer than it was sitting in a bank because they figured the bank might be possibly connected to the stock market. This caused a lack of cash in banks because everyone's going out withdrawing all of it. And this starts to cause banks to fail. Over a period of about 1.5 to 2 years, around 11,000 banks closed in the United States. In fact, there are some states in the United States, in our country, that were left without a single bank open by the time it was all said and done. Millions of people, when these banks start to close, they lost everything that they had. Unfortunately, back then, when a bank failed, if you weren't one of the fortunate people that got your cash out in time, you were left with absolutely nothing, right? It was just gone. Here is a fantastic political cartoon of the day from this time that really outlines how a lot of people felt about this. So you have this tiny little squirrel here that comes up to the guy on a park bench, and he simply asks, "Hey, why didn't you save some money for the future? You know, when times were good, why didn't you stash it back, kind of like I do with my nuts that I find?" And the guy simply responds, "I did." Unfortunately, like the little tag says on the victim here, he was the victim of a bank failure. Through no fault of his own, he wound up losing everything that he had. And to make things even worse, when banks start to close and go out of business, other businesses start to follow and they start to fail or cut back. So businesses, if you aren't aware, businesses rely on banks basically to be able to operate. Businesses have to have a steady flow of borrowing money and investing, putting money back into their business, kind of have this cash flow back and forth thing going. And without banks around, businesses really started to see an impact. They were unable to find people to loan them money like they needed them to because all the banks were failing and closing up. A lot of businesses, therefore, needed to figure out ways that they could cut costs. And so they started just to lay off workers, to fire them and say, you just don't come back. We don't need you anymore. We need less workers here. You're costing us money. We don't want to pay you. And people didn't have jobs because of this. So they didn't have any income, right? That's what happens when you lose your job. You don't have any more income coming in. So people couldn't buy stuff anymore, which meant businesses had to figure out a way to cut costs even more, right? Because now people are unable to buy their products because they're getting laid off. And so what do the businesses do? They have to cut costs even more, and they end up laying off more of their workers, right? This is a cycle. Eventually, this cycle causes a lot of businesses to start closing. And by 1933, America is hit with the largest unemployment rate that we've ever seen in our history, at 25%. So 1 out of every 4 people is left without a job. And I really only have 2 takeaways for you from this lesson. Number 1, remember the 4 main causes for the stock market crash: speculation, buying on the margin, falling stock prices, and the loss of confidence in the market itself. And the second big takeaway is remember that the crash really led to bank failures, and that bank failures led to business failures. And when businesses fail, things aren't going to be good. So there you go, guys. The stock market crash of 1929. Hopefully you got some great notes and you'll be ready for the final when it's time for the final in a couple weeks. Let me know if you have any questions. I'll be sure to try to help you out.